Before we get started, I'd just like to acknowledge the lands on which I'm calling in from today, the lands of the Wurundjeri people. I also acknowledge the traditional custodians of the various lands on which you're all joining in from today, which you're most welcome to share in the chat. I pay my respects to elders, past, present, and acknowledge their ongoing connections to the skies, lands, and waterways throughout Australia. So, who are we? I think we've got a few new people joining us that haven't made our previous one. So, for those who don't know us, Anthesis is the world's leading purpose-driven, digitally enabled, science-based activator and the largest group of sustainability experts globally. So, we help companies strategically reduce emissions, navigate sustainability frameworks and regulation, like these new ones, address human rights issues, and plan for climate-related risks and opportunities. Some of you may know us from our former company, Endeavour Environmental, which operated as a leading climate change and sustainability consultancy from 2010 to this year when we rebranded as Anthesis. And we are proud to be a B Corp. So who are you be hearing from today? Myself, Hannah. I'm a director at Anthesis and lead our ESG mandatory reporting team. Daniel is one of our principals and leads our net zero service line. And Catherine is one of our valued clients, the head of sustainability at EVT. So thank you guys for joining us to share your knowledge today with everybody. Today we're going to do a quick deep dive into, again, mandatory climate-related financial reporting. In this third one, we're focusing on Scope 3 emissions. There was quite a lot of excitement at the end of the last one about this one, so no pressure, Dan and Catherine. Dan's going to talk through the process of identifying and measuring Scope 3 emissions, and then Catherine's going to provide some valuable insights to someone who's just gone through the process herself. As per the previous ones, this is complex. Our aim is to demystify it as much as we can for you in the next 30 minutes, but appreciate that there's a lot to cover. So please put questions in the chat. We're just going to put a poll up now to kind of gauge where everybody is at that can help us steer the conversation as we go through, which Jacinta will pop up. And just note for everybody, this is being recorded. You'll get a copy of the slides afterwards and a link to the recording as well. So let's jump in. Well, before I do, actually, while the poll's coming up, exciting news, which I'm sure a lot of you are aware of. Everything is now locked in, so we finally have some certainty. The legislation's assented. The final version of the standards have been approved at the end of last week, and now they're more closely aligned with the global ISSB standards. So exciting times. And as we've talked about in our previous webinars, this is a big task for a lot of reporting entities. So as I've mentioned, our aim today is, and with all our other sessions, is to really help you prepare. So I'll pass over to you, Dan.
Thank you, Hannah. So firstly, I'll be speaking about the Greenhouse Gas Protocol and the different frameworks which it's applied to. So as you can see here in the diagram, this is a map of Scope 1, 2, and 3 emissions. And just to give you a brief overview, the Greenhouse Gas Protocol is the guiding document on how to calculate emissions across all the emission sources you can see on the screen. And then moving right to left, you can see Climate Active cuts across Scope 1, 2, and predominantly upstream Scope 3 emissions. The National Greenhouse and Energy Reporting Standard deals with Scope 1 and 2, and those who come from large organizations may be familiar with NGERS. Then you have science-based targets, which refers to full value chain, and that is your entire up and downstream emissions. And then you have PCAF, which is the very last item on the right-hand side, which is investments. And those of you who work in financial institutions may be aware of PCAF. Now, for those who are asking, what are Scope 3 emissions? They are emissions that arrive from your value chain and a result of your daily business operations. Looking at the image you can see in the bottom right-hand corner, you'll see there are 15 different categories, which are split between upstream, such as the emissions that arise from purchased goods and services, business travel, and waste, and downstream emissions, which are emissions that arise from transport and distribution, product use if you're a manufacturer, and franchise emissions if you franchise out your branding. Now, it's important to remember that Scope 3 emissions, by definition, is double counting. That is because your Scope 3 emissions are someone else's Scope 1 and 2 emissions, and often someone else's Scope 3 emissions. And that is a result of working across your value chain. Now, what are the benefits of measuring Scope 3 emissions? To name a few, by measuring your Scope 3 emissions, you're able to identify greenhouse gas related risks in your value chain, identify hotspots within your Scope 3 emissions to prioritize reduction efforts. It helps us set reduction targets, and it also gives you the ability to understand where those emissions rise from, so you can partner with suppliers, customers, and other companies to achieve reductions. Okay. So under the mandatory reporting standard ASRS, entities are required to apply the greenhouse gas Scope 3 standard, and that takes into account the full value chain of upstream and downstream emissions. So there were the 15 categories that were showed in the diagram of the previous page. So what I'm going to walk through now is the process of Scope 3 as outlined by the Greenhouse Gas Protocol and our tips and experience from clients. So we'll note here that there is flexibility within the standards, and I'm going to talk through the process of how you calculate your emissions and talk through the steps on how to do so. When calculating Scope 3 emissions, it's important to understand the boundaries, the categories that you need to calculate, and how your footprint or inventory compares against your peers. Now, I feel most people in today's audience may be aware of the diagrams you can see on the screen. It's a simple overview of how to calculate your inventory, so I won't spend too much time in today's webinar talking about this process, as Hannah mentioned. These slides are going to be sent out after today's session. But at a high level, it's important to note that the process of calculating your inventory is a result of multiplying activity data with an emissions factor to arrive at total emissions per emission source. So when you calculate your inventory and Scope 3 emissions, the first step is always to determine your reporting boundary by identifying relevant emission sources. To do this, it's a matter of selecting an appropriate control method, as different control methods can be used to allocate emissions within a reporting boundary. The most common control method is operational control. That frequently stems because it's the only method you can use under NGES, but you can also use financial or equity share as alternative approaches, which may need to be considered for mandatory reporting, especially for financial institutions. Once you've selected your control method, it's then a matter of applying your operational activities against each of the relevant criteria that you can see on the right-hand side. It's important to note that there is a trade-off when selecting a control approach, as it's not often a one-size-fits-all approach, particularly if your organization operates in various different areas. But it is important that you choose one control method and apply that consistently, so you can't chop and change between categories. Now, the diagram you're looking at on the screen is to illustrate what a reporting boundary looks like. In this example, a company has 4 different business areas: restaurants, leisure centers, property, and corporates. And each of these business areas have been applied for relevance or screened for relevance across scope 1, 2, and 3 emissions. And what you're looking at in this diagram is the outcome of a boundary assessment to determine which emissions from each of these business areas arrive across scope 1, 2, and each of the 15 categories. Looking at downstream, you can see that this organization doesn't trigger all downstream categories, and that's not abnormal. No. Now, once you have set your reporting boundary and identified relevant emission sources, the next step is to obtain data to calculate those emissions. This step can often be the most challenging for organizations who are just starting out on their journey. And this is because we find with most of our clients that organizations aren't typically set up to capture the scope 3 data that we need to develop an inventory. So to give an overview of the type of data that can be used, the diagram on the right-hand side shows the different type of data that can be used from the highest to lowest quality, with activity data at the top of the pyramid being the most accurate data you can use. And an example of this is kilowatt hours of electricity usage or the weight of waste that is collected. When actual activity data isn't obtainable, we then work down the hierarchy and work from the green at the top down to the red, which is an uplift or estimating data based on industry averages to close the data gap. Earlier, I mentioned that the step of calculating or obtaining data can be the most challenging, but this shouldn't deter you from starting with the process, as we often work with clients with the intentions of improving the data quality over time. And this is not an unusual process where this can take several years to move up the hierarchy and obtain activity data where possible. And again, when organizations are working to improve the data, it's a matter of having the ability to segregate data, because often organizations aren't set up to capture data as we need it, or working with suppliers to obtain better data. Now, to demonstrate how different data can be applied to calculating the inventory, I'm going to use category 1, purchase goods and services, and category 2, capital goods, as an example of how emissions for these categories can be developed. And that's because they often rely on financial data. As you can see in the diagram on the right-hand side, there are 4 ways to calculate emissions from these categories, ranking from the most preferred to the least, with supplier-specific data being the most preferred method. And that is when a supplier can actually give you the intensity of the service or the good that they are selling you. And that's a result of them doing their own calculations. The least preferred, but by far the most common method, is the spend-based method, which you can see at the bottom of the screen. This is where data is obtained from an organization's general ledger or profit and loss statement and is used to calculate emissions. Generally, using financial data is seen to be the most conservative and is therefore seen to be overestimating emissions just by the nature of using industry averages. However, as I said earlier, the spend-based method is by far the most common method, and it is not uncommon for organizations to primarily use spend-based data to calculate their scope 3 emissions in their base year or their first inventory. And that is because that might be the only data they have available at the time, and that connects back to improving data over future years. Now, Now that I've had the opportunity of talking through the process of calculating Scope 3 emissions, I think it's fair to say it is complex. And in addition to reporting Scope 3 emissions under the new mandatory reporting guidelines, organisations will also be required to have their inventories assured. And carbon accounting platforms like Anthesis Route Zero software can really help navigate these processes and challenges. That's because the tool, being a carbon accounting software, is designed not only to help you calculate your emissions, but it also provides the ability to host the data that you source to calculate those emissions, and therefore it helping to minimize the risk of data loss and misplacement during that assurance process. Cool. Now that I've had the opportunity to talk through the process of how to calculate Scope 3 emissions, I'd like to hand over to Catherine, who's recently gone through the process of calculating EVT Scope 3 emissions.
Thanks, Dan, and hello, everybody. So I think as I was sort of thinking about this session, I felt that there were two main themes. The first theme is Scope 3 as a concept, and the second one is how you bring your team with you. So in terms of that first piece around Scope 3 and the concept of Scope 3, I think there's three aspects of it. The first one is context, the second one's complexity, and the third one's credibility. And if we think about context for a minute here, I think it's really important to reflect on how far we've come and where we are today. So Scope 1 and 2 are considered quite straightforward. We're usually used to asking for that information from our suppliers. We're perhaps used to receiving requests for that information. And over the last 10 years, it's become a pretty understood process, and we're all used to kind of handling it and disclosing it. And we're also used to having that information assured. It's a known quantity, if you like. Scope 3 is still quite a relatively new concept. So we're very much on that path around building that knowledge, understanding how we connect to others in our ecosystem, and improving the data and making it assurance ready. So we're establishing norms for all of that happening. And I think that over the next few years, we'll see a lot of that comfort grow as it has with Scope 1 and 2. And I think, despite some of those challenges, the destination is still the same. I think stakeholders are asking about Scope 3 and being clear that it is absolutely part of what they expect to see around emissions reporting. And as importantly, the regulator has been really clear about it. So I think, there's quite a bit to understand in terms of your organisation and the context at large, but the destination is where we're all going to get to at some point in the not too distant future. But it is complex. I think Dan's done a great job of outlining some of that complexity. And something that really became clear as I went through the process and the EVT team went through the process around Scope 3 is that the Greenhouse Gas Protocol is a great document. It provides excellent guidance. It's a strong foundation. But it isn't perfect, and it's not really a legal document. It probably wasn't ever really designed to be that. It also wasn't designed specifically with financial accounting in mind. And so there's a little bit of a gap there to understand how those two things aligned. And in reference to Dan's slide around relevance, there's definitely some trade-offs and some thinking to do about how each aspect of relevance is material to your business. And for EVT, it actually took a few iterations to get to the point where we were comfortable with our operational boundary and where it landed, and that reflected the scope of our Scope 3 emissions. So I think that's something that's worth bearing in mind, that it is iterative, that it's not completely exact, and that's okay for just now. And yeah, we use spend data to start. We had a little bit of activity data, not too much at this stage, and we also made use of uplifts and estimates as well. So I think, probably from the sound of what Daniel said, most people are starting there as well. And it's important because it's part of being credible around understanding your emissions. Scope 3 is part of that credibility piece in recognising the full value chain, and it's part of Science-Based Target Initiative as well, if anybody's interested in that. We're recently committed to the Science-Based Target Initiative, and we're about to go through the process of validation, which I think will be really interesting. So that's the first sort of area that I wanted to talk about. And the second one, so crucial, taking your team, bringing your teams with you. As someone who sits in a sustainability space, so much of an in-house role is engaging with team. And my thinking on this is that most people I engage with in our business understand that we need to address the issues of climate change and nature and all the other aspects of being a responsible business, and really just need to be shown a path. How do I, in my role, be part of this change and this progress? And I think, when us establishing that path is such a crucial role of a sustainability function. When we started to think about Scope 3, it was about a year ago, without having done all of the modelling and the estimates yet. I think, there were still some aspects that I can point to that would probably end up being some of our areas of focus. So, purchased goods and services, particularly food and beverage, are important for us as a hospitality, travel and leisure group. And likewise, on the other side, waste was important. And I think everybody understood that intuitively, but it really wasn't until I could show what some of those numbers look like and what the proportion of that was in terms of our emissions, and particularly the fact that Scope 3 is about 71% of our full emissions profile, and that's actually quite significant. So I think that was when the graphs and the pie charts and the numbers started to come out. I think it really began to help people understand, well, what are the levers that we have? How do we focus on the areas that we can drive the most change? What are the material changes that we want to make in the next few years to achieve our goals? So I think that's the bit that really began to connect with our team. And I think it also started to perhaps challenge some ideas about, particularly around waste. And, actually prevention is is as important, if not more important, than potentially diverting and recycling. So it helped people think of everything as a system and their ability to make decisions in it. And so, yeah, that really helped, helped our team start to take action, and it sort of provide a bit of clarity, and I think it grew our team internally in terms of how much they understood and engaged with sustainability. And I'm really excited about the next few years and continuing to grow that in our business. And likewise, everybody on this call, we're all part of team sustainability, so I'm very collaborative in my approach, and very happy to be connected to and support the whole uplift that we need to meet our climate goals. Thank you.
Thank you, Catherine. Thank you, Dan. I'll just pause for a second and everyone can post any questions that you might have. But while everyone's doing that, we'll just put a couple of key takeaways from today, and I'll invite Catherine and Dan to add to these dot points if they like. But as they've both discussed, this is a whole of business process, as Catherine just talked about. Bring your whole team on this journey. It is complex. Don't be afraid to ask for help, whether it's from a consultant or whether it's just from people in your network that you've worked with before that have gone through this process like Catherine. There's never going to be perfect data for Scope 3, or very rarely. So start with what you do have and then improve that over time, as Dan talked about, moving through the hierarchy. Don't think we've ever seen anyone have perfect data straight away. And what is perfect anyway? But I guess on that though, start now, because it does take a while, and this is going to lead into your public disclosures. So you do want to have some level of comfort in what you're putting out there. And as Dan talked about too, moving up from spend-based data to that activity data really helps when you get into the reduction process, and that setting targets and tracking your reductions is another part of mandatory reporting. I might also add too to that, linking it into our last webinar, we talked about climate risk. Looking at your scope 3 value chain is a really good way of identifying those transition risks that we talked about last time. So there's a lot of overlap in these requirements. So make the most of having to do what you're required to do as efficiently as you can. Catherine or Dan, did you want to add any extra key takeaways as we wait for some questions to pop up?
For me, I'll echo those points as well. It is it's never a perfect process. It is very much an iterative process. It will evolve over time, and not only will organizations get a much stronger grasp moving forward in terms of what's required and how to capture that data. So will your partner, be it a consultancy, that can support you through that process. So yeah, very much echo start as early as possible.
And we do have one question. We've got a couple of questions popping up, so I'll put this one out there, and maybe Catherine, you might want to go first. Someone's asked about how much the procurement functions support this journey of scope 3 reporting. Maybe you could talk about, did your procurement team help you? And then Dan can elaborate on more broadly.
This is a great question. I really hope, I can see it's Silka. I really hope you're in procurement, because so much is the answer. Procurement is really the foundation of how we can drive achieving scope 3 reductions. There's just so many aspects of it. And look, it does depend a little bit about how your organization's set up in terms of procurement, how centralized how devolved it is. But in terms of the strategic value that procurement can bring to the table, it's almost unlimited. So I think, aspects of it are, procurement, the suppliers, your main suppliers, you have great relationships with them. It's really the best way to start asking questions about what their plans are to have emissions reduction goals. Are they thinking about recycled material? What could that look like? Could you even kind of start to share some of each of your challenges and see how you could come to kind of a mutually good outcome from a sustainability perspective, but also from a commercial perspective? Because that's a really important thing as well. I think, yes, there's definitely some aspects of sustainability that have cost implications. We can't just brush over that, but there are definitely some aspects of it which perhaps don't and actually offer some commercial value. So there's the engagement with suppliers, which is really fundamental to scope 3, because it is all about suppliers, if you like. So yeah, I hope that answers your question.
And we have a couple more. I'll try and squeeze in. We've sort of a few more minutes left. Joanna's asked, what is your recommendation for small to medium businesses that may not have mandatory reporting but do have large business customers? I don't know, Dan, if you want to take that one, because we have had a lot of inquiries, because now the larger companies need to know their emissions are starting to push that down onto their supply chain. Yeah,
it's a great question. And look, the process for calculating full value chain emissions is the same for everyone. For smaller organizations, it's fair to say it's a lot less complex. So you might not trigger as many categories, particularly if you're more like a professional service organizations, you would very rarely trigger your downstream emission categories. So I would say it's similar in nature, but simpler in due process. So don't be overwhelmed by the nature of what's required, because any organization can do this, large or small, from 2 staff to 500 staff.
And there's some, sorry, I was just going to add that yes, so we are probably one of the businesses that are asking more questions, but it's just the start of that conversation. I've had I had some conversations yesterday where I was saying, well, these are the things that we're looking for in the next year, couple of years. How do we work together to get that happening? And the other thing that I've come across recently is there's some actually for quite small businesses, some quite good online calculators to just start getting that thinking and that process and that data going. You probably then want to look at it specifically for your business and add that kind of layer of personalization, but I think they can be really good places to just start getting a handle on it.
Thank you. And I think, thank you, Amy, you're answering some of the other questions in the chat as we go, because we are coming up to time now. So thank you, everybody. Please keep the questions coming, because we'll answer them in the chat once this is closed, which you'll get a copy of too once the recording is available straight after this. Hopefully this has helped and demystified some of the scope 3 journey, and hopefully it doesn't seem as daunting. Just remember, one step at a time. You guys will be all right. You're not alone. Everyone's kind of going through this process. Our next webinar coming up will be around breaking down the transition planning, which is another requirement under the mandatory reporting. And then we've got one focusing on a materiality and then looking at effective reporting. As always, so if there's any other topics you'd like us to cover, please send them through. And thank you again for joining us. Thank you, Catherine, so much for joining us before you're about to head off on leave. Thanks, Dan. Thank you, Amy. And thank you all. Have a lovely day.